Tyler, we've made a lot of videos about Enphase, usually with SolarEdge. You can almost say like it's frenemy in the panel level solar electronics business that they both kind of a duopoly and dominate. Today's, we're just going to focus on Enphase. Stock is up as we're recording this on the 19th. It's up 7 or 8% on a good reaction to bad news or expected news that the market's reacting positively to. Let's hash through this. There's a lot to cover, right?
Yeah, it's another one of those things where, hey, we had to dig through some SEC filings and look what we found.
Yeah, the company didn't drop a press release. There's an SEC filing and there's a blog post of a letter from the CEO to company employees. We'll get into the nitty gritty of what's going on with Enphase that has its stock up, why investors should be cautious of it and understand exactly what it is, what it means for the near term and the long term. I'm Jason Hall. This is Investing Unscripted. This video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, go to our special link. Go to fool.com/unscripted. The Motley Fool is going to give you its 10 best stocks to buy right now. Okay, Tyler. So a little bit of backstory here before we get into the new information that we have through both the blog post, the company blog post on the website, and through the filing. We've been talking about this for a couple of months now. What's going on in the solar industry, particularly the distributed solar, like so residential and rooftop solar, that sort of thing, that's caused Enphase and SolarEdge's stock to both crash hard. And the bottom line is that demand is just drying up. This part of the cycle has gone from super high growth. The market's pulling back as potential buyers are taking some steps back, dealing with higher interest rates, costs more money to get a loan to get solar panels now. Some changes in California and other markets to the credits you get for solar production that have got the market a little bit affected there. What's going on broadly? What do you see here?
You mentioned two of them already, and it's the things that Enphase CEO actually even mentioned in his letter. The two that really stick out the most is the California market and Europe. Let's start with the California market because for a while it was distributed solar's best friend, and then it took a very quick change of pace. I think it was a couple of years ago, there was a California law that basically said any new single-family home residential construction required the use or the installation of solar panels on them as like a resiliency, renewable power initiative. And as a result, sales and for companies like Enphase and SolarEdge, whose products are largely used in residential distributed solar. You had a booming demand. California was already one of the largest states in terms of demand for distributed solar.
Three favorable things for solar. Number one, it is a massive state, massive population, large economy, lots of sun, favorable weather conditions for the production of solar power, and generally favorable governance and regulation.
Yes.
Add those three things together, and it's been a huge winning market for the solar industry writ large.
There's a component of the regulatory part which has made California and some others very attractive for quite some time. They're called net metering rates. And the legislation basically said if you are to sell electricity into the grid, you sell in at the same rate you would be buying in that moment. So you're getting...
So every unit of power you produce, you can exchange it for a unit of power that you consume instead of you're selling your power at wholesale cost, but then you have to buy it back at retail cost.
So there's been a lot of back and forth with net metering rates in California and a lot of other states for that very reason. Like you said, utilities will make the arguments like we have to install all this transmission lines and we have to build all this resiliency into the grid, but we're not getting paid for it because we have to buy power at retail rates from these individuals. And so California basically started to bend to this a little bit with the new rule. The new one basically said, look, we're not going to buy at retail rates at any given moment. And what we will, especially for anybody who doesn't have their own power storage unit built into their residential installation. However, if you have a battery backup and you sell into times of high demand and you're not selling into the low demand periods, which is 2 p.m. when solar energy in the state is booming and people aren't home and turning on air conditioners, there's a famous curve. It's called the duck curve. It's basically power demand and supply in California. You can go take a look at it if you have a chance, but it's basically showing like demand and supply of solar power at any given moment. And it was becoming troublesome for the grid in California. And so they added this implementation saying, look, we'll we'll pay for it if you have a battery backup because we'll pay for it at certain times, but don't expect us to pay net metering rates when we don't need this power. And so just indiscriminate installation of residential solar kind of back down a little bit because the added costs of adding battery packs is a big deal. And because of that, you're seeing a little bit of slowdown there in California in particular. Europe is probably pin that just a little bit more on tepid demand in terms of economic growth, higher interest rates. They're still dealing with inflation a little bit more than we are here in the United States. And the central bank there has been still looking at increasing interest rates to fight inflation. So it's a little bit harder to finance these projects over in Europe and just the other ancillary geopolitical things that are going on there. You throw those two things together, and the demand for residential solar has taken a hit for Enphase, for SolarEdge Technologies. Both of these companies have just said, look, it's not another period of gangbuster growth. We're probably going to have some flat to declining growth as a result of some of this. And so Enphase came out and said, look, we need to cut costs. We expect this to be a challenging environment. And the CEO basically said, look, we need to face the music here and are doing something about it.
So this goes back a while. So we can go back to Enphase's Q3 earnings results, and you go before that. SolarEdge got the ball going when they pre-released some of their numbers and set forward guidance that was going to be substantially lower than anyone expected. And then Enphase stock, of course, fell right along with SolarEdge because they're very much tied at the hip in terms of the exposure to the same end market. But again, the key here is we saw revenue fall from $711 million in the second quarter to $551 million in the third quarter, which was well below where it was the year prior. And then when management gave its guidance for the fourth quarter of the year, they're talking about $300 million to $350 million in revenue, which is a massive decline. So we already knew, Tyler, like you said, the telegraph, the business was going to be bad. And there was an expectation they were going to have to do something. We've talked about the strength of the company's balance sheet and its ability to ride things out. But management said, okay, we have to make a serious change. So if you go on Enphase's website and their blog, find the link to the blog and you'll see they announced some things that they're doing. So 10% reduction in its workforce. They're closing operations. They don't own their internal manufacturing is minuscule. It's almost entirely contract-based manufacturing. So their Romania and Wisconsin facilities are closing. They're sending the manufacturing equipment from those sites to their two primary sites that are located in, I believe, South Carolina and in Texas. And the idea is they want to be able to drop their manufacturing capacity from 10 million units a quarter down to 7.25 million units per quarter. And the dollars to know, because it really comes down to the dollars with this, is they're looking to cut their non-GAAP operating expenses from just under $100 million where they are quarterly to $75 to $80 million on a quarterly basis. So they're looking at taking those numbers and dropping them 20 to 25%. Substantial cut in operating costs. Not a big surprise they're doing this, right?
No, like we've been talking about in these previous videos, is the idea that we're headed for a more challenging period for an industry or two companies in this industry that have more or less defied gravity for quite some time. You and I have had multiple discussions over the years about both Enphase and SolarEdge. Defying what we had known in the solar industry for so long was that they go through these cycles, margins tend to be pretty thin, it's a race to the bottom in terms of your cost structure and things like that, and you move down the commodity curve, and that just hasn't been the case with these. And this is the first time it seems to be happening. And so there's part of it that just goes, they're going through their first real down cycle relative to like their younger existences as companies. And so to me, it's a little refreshing to see they're going to respond to it pretty quickly. And like you said, having contract manufacturing is very beneficial because it's cheaper, it's easier to move, you can shut it on and off pretty quick. And I don't know if this 20-25% reduction in overhead costs is going to solve all their problems, but it's a good step in the right direction.
I want to talk about the balance sheet again just for a second. So short version, substantial amount. The purple line, this is cash and short-term investments. The orange yellow line, this is debt, about 1.3 billion in debt, about 1.8 billion in cash. Plenty of liquidity on the balance sheet to continue to fund the business as they make these changes, talking around about a little less than $20 million is what they're expecting to take in the cost of doing this between severance, and I'm sure they're paying some money to their contract manufacturers to get out of these contracts. So they're saying about $18, $20 million roughly in the next quarter. I wouldn't be surprised if there might be future additional costs that they have to pay in quarters after that. So don't rule that out, I think is important. What's interesting to me, Tyler, as we wrap this up, thinking about Enphase, where investors should be thinking about it, is we did a video, it's been several weeks ago, looking at it and thinking about going forward. You took the approach of saying, hey, let's be cautious about this because this downturn could last longer and could cost more than maybe we're expecting. Of course, I took the more optimistic approach and said, this is maybe a good time to buy, thinking about building out a position over time in this business because the cycle is going to turn. And I think the companies are going to be positioned pretty well. And what we've seen is the market has, between the pause on interest rate rises from the Fed and now viewing this as good news, this stock's up like 30% over the past month or so. Where do you think about Enphase stock right now? I'm assuming you're probably still viewing it as probably good to put on a watch list, but maybe not the right time to buy.
Yeah, look, you said it was what, up 30% in the past month or so? It's still down 50% year to date. Let's keep this in perspective here. We're expecting a significant decline in sales coming up here in the fourth quarter, and we don't know if that is the bottom or not. And there's been a stock market rally, and these companies benefited largely because of that, because the thought of interest rates staying here and maybe get going lower a little bit in 2024 seems to have everybody very excited. If we have 2 or 3 quarters of tepid demand and declining revenue, I can't see a lot of investors getting terribly excited about seeing that. So again, I'm still in the wait and see approach. I think there could be an opportunity to swing at a fatter pitch on this one.
Between the stock price having come up a lot from where it was when we recorded that prior video, and also management taking really serious action about one thing that I'm really concerned about, and that's its ability to ramp production quickly when demand does recover. Making these moves is going to affect their ability to rapidly ramp production back up. They're saying they're going to cut their production capacity by 25%. That means that when the cycle does turn, they're going to have to spend money, relocate equipment, sign new partnerships with contract manufacturers who may not be as favorable at the terms they extended based on how quickly the company is moving away from them right now. So all of those factors come in. I'm moving into Tyler's camp here, and I do think that now it's time to be a little more cautious, mindful of the risks, and also the company's ability to respond and be resilient when the cycle does return to growth.